Good afternoon, all. As Kerva said, this is already the 8th overall in our series of What ESG Investors Want webinars, a platform to really give you direct insights into the priorities and considerations that the ESG-focused buy-side faces. And I think it's highly topical to be talking about sustainability-linked bond market, which has really gone from virtually non-existent only a couple of years ago to now being around 10% of the global sustainable debt market. Very pleased to have with us three members in our panel. We've got Barbara Calvi from Morgan Stanley Investment Management. We've got Bernhard Gruneugel from Bayern Invest, and we've got Bram Bos from NNIP. In terms of the format, as you're used to from our series, we try and divvy up a topic into three themes. So I'll go through the first theme, my colleague Nikesha Perry through the second theme, and then I'm returning for the final one. The first theme is how SLBs fit into an investment portfolio. And the second one is preferred KPIs and targets for SLBs. And then the final theme focuses on the economic incentives associated with SLBs. As always, we very much welcome your questions. You can flag them through the usual Zoom Q&A link that you should see on your screen. And there'll be ample opportunity for those to be answered towards the end of the session. But with that, let us kick off. So the first theme: how SLBs fit into ESG investment portfolios. And perhaps Barbara, beginning with you, from an MSIM perspective, how can SLBs support your different investment strategies?
Thank you very much, Arthur, and good afternoon, everybody. It's a pleasure to participate to this workshop. In terms of how we look at sustainability-linked bonds, to be honest, they can fit in any of our fixed income strategies. So we can potentially invest in SLBs as part of the so-called regular fixed income strategies, both on the corporate side, on the multi-sector side, as well as in specific sustainable strategies. I think we need to make a distinction between what we would consider as a sustainable investment in the context of the label versus other sustainability-linked bonds that could be more compared to some extent to a traditional transition bond in terms of the type of issuer, the sector, the potential KPIs that are selected. So it's not a sort of binary decision just depending on the label. It's really a matter of looking at each issuance in detail, at the issuer itself, and the way the business activities are conducted and the ultimate targets of the issuers. When we think about our sustainable strategies specifically, there are a number of constraints in there that we need to keep in mind when assessing the sustainability-linked bonds and whether they are potentially eligible or not. And clearly, we need to take into consideration that as part of these strategies, there are often quite a number of restriction screens that are applied in terms of the type of business activities that are eligible. Clearly, in some cases, these also involve certain types of fossil fuels, in particular coal, any unconventional oil and gas, and then more broadly, exposure to energy sector, for example, could be potentially more challenging unless it's really justified by a very, very strong low carbon transition rationale and strategy on the part of the issuer. Now, there's an additional constraint, clearly, which is that in many cases, these sustainable strategies also tend to come with a low carbon objective or a net zero objective. And therefore, we do recognize that in many cases, the sustainability-linked bonds, as well as other green bonds and labeled sustainable bonds, do have a catalytic role with respect to accelerating this process. But unfortunately, from an investor's perspective, we need to face the reality that in many cases, issuers have a very high starting point when it comes to their current level of greenhouse gas emissions or intensity. So this is also an additional constraint when considering these SLBs. But clearly, to the extent that they help via these KPIs and targets accelerate the process, they potentially make the instrument eligible for that type of universe within a pretty short time frame if they manage to actually reduce that intensity pretty quickly. So all of these are considerations, and ultimately I've mentioned the sector. So clearly we need to be a little bit selective in this case. We understand that there's like an increasing range of companies that come to the market with this type of instrument and structure. But once again, we need to make a very granular and detailed assessment in order to basically evaluate what's really the transitional potential of the overall business model and whether it makes sense for our portfolios in terms of philosophy and core values.
That's very helpful, Barbara. So the SLB label can certainly be indicative of a good transition strategy, but as you say, you need to dig underneath the surface before making an ultimate investment decision. And perhaps, Bram, turning to yourself, there's clearly these two camps in the market, right? Green bonds, use of proceeds bonds, vis-a-vis sustainability-linked bonds. How do you see the two pairing up at the moment when it comes to your ESG strategies?
Thanks for the question, Arthur, and good afternoon, everybody. And just to answer the question very direct, I think green bonds and SLBs, it is a different product. Green bonds and also the whole use of proceeds concept, in our view, is really a form of impact investing. So you are really channeling the money towards specific projects and you're measuring the impact. And SLB is a general corporate purpose bond. So from that point of view, it is a different product. It is also more at its infancy stage, I would say. I think we all know that with green bonds, the green bond market and also the social bond market to some degree is already existing for a longer period. There are some international taxonomies already available indicating pretty clearly what's green and what's not. And for SLB, I think that is all yet to be developed. So I think, I do understand that certainly everybody's talking about SLBs, but at the same time, I think the whole SLB concept can work in the long run, but I think we have to develop much more in this space to make it a credible product. And that's also why we really distinguish. So in contrast to Morgan Stanley, we do distinguish clearly between green bonds and sustainability linked bonds. And that also means that, for example, sustainability linked bonds, they do not fit in our green bond strategy. Again, green bonds and the use of proceeds concept is a form of impact investing, and sustainability linked bonds, it's not. It does fit in our normal strategies, like normal credits, sustainable credits. But again, we are not making a specific allocation to these instruments. If we buy SLBs in those portfolios, it is because we think the underlying company is sustainable, is moving in the right direction. But the added value of the SLB structure is quite minimal at this stage because, let's face it, we don't really know when a target is credible, when it's impactful. There's still a lot of question marks to be answered before we realistically can say, okay, let's make an allocation to SLBs separate from the rest of the portfolio. So I think we are not there yet. We might get there, but again, a lot of work has to be done.
Thank you, Bram. And indeed, we'll be spending more time later on that vexed question of setting credible targets within SLBs. Perhaps better turning to yourself and maybe quite blunt, but thinking about types of issuers, there is a view out there that SLBs is second best. In that if a company has got very green capex, should definitely do a green bond SLB in certain other situations. How do you look at that? How should companies think about the two instruments? But perhaps, Barbara, turning that question, if I may, to yourself. So how do you think companies should consider that question of issuing a green bond vis-a-vis an SLB instrument? And indeed, any sort of thoughts on Bram's point around different strategies for the different instruments?
Yeah, absolutely. I mean, I think Bram definitely has a good point, and that's why I was differentiating at the very beginning amongst different type of SLBs. And that's also the reason why I mentioned we need to look at the issuer's profile before assessing whether an SLB does fit potentially in one of our sustainable strategies or not, because not all SLBs would be automatically eligible for that type of strategies. We do recognize, however, that the green format doesn't work for everybody. And that is probably why SLBs are gaining so much traction and so much popularity. There are some sectors that do not have that very high level of capex, and that's simply a fact. And probably the SLB format works much better for them as opposed to being earmarking different types of operational expenditures, for example, which have been pretty controversial in the investor community as well. There might be more clarity going forward with the EU taxonomy being finalized or with the UK taxonomy subsequently being finalized, which also spells out the various types of expenditures and then the specific potentially look-back periods that are applicable to that. So that should bring a little bit more order. But the fact remains that different sectors have different profiles. So to the extent that this opens up the market to more players that have genuine commitments towards sustainability objectives, we do think it's a welcome development. But once again, there is an enhanced risk of greenwashing in terms of what Bram was mentioning, the level of ambition of those targets. And I assume we're going to get into much more detail on that point when we speak about the metrics and targets, the comparability of those. It is indeed a nascent market, and there's a lot that we as investors need to still learn in terms of enhancing our capability to also compare peers and the objectives that they set and how they calibrate those targets. And this is also one of the reasons that we currently rely on second-party opinions, and we also engage with those second-party opinion providers for them to provide as granular reviews as possible with a lot of details and to facilitate that comparability process. But having said that, yes, once again, it's different types of instruments. They need to be assessed on an ad hoc basis, but we do welcome them in the market in terms of, again, broadening the universe and opportunities, and once again, bringing more transparency to the table, because they still have an enhanced reporting commitment and an auditing commitment associated with the structure, which we think is an added benefit.
Thank you, Barbara. Berit, I think we're reconnected to you now, and we've heard from both the other panelists emphasizing, this is still a market that's nascent, that's in its infancy. I guess at Bayern Invest, how do you look at SLB bonds vis-a-vis other sustainable investment opportunities?
Thanks, Arthur, and sorry for my technical issues. I dropped off. So we at Bayern Invest, we are definitely looking for the market to grow further, and we are fairly enthusiastic that it will definitely grow across sectors and across issuers, and we deem the sustainability-linked bond market as such appropriate for all type of sectors and issuers. So that's definitely the case. Also, I would agree with Bram and Barbara that the market still has to develop, and we need more transparency, and the level of ambition regarding the targets has to improve as well. So that's definitely correct. But I think the market has done a good start, and it will develop further. That's the case. What we can see at the moment is that more and more issuers are setting themselves sustainability targets, environmental targets, and carbon reduction targets, and it's quite the natural extension of setting a target that you also link your cost of debt to that target to have some sort of fostering the commitment to that target, and that also helps us on the investor side to gain confidence that the issuer, that the company is indeed transforming itself and moving in the direction of a more sustainable economy in the future. So that's, in my opinion, really a perfect fit between companies on the one hand and investors on the other hand. And as well for certain investment strategies that set themselves, for example, the target to align with Paris goals, etc. That might indeed be the perfect fit if the bond or the issuer sets a target and sets a level of ambition that is itself also consistent with Paris goals. Then it also is, of course, a natural fit for investment strategies that pursue the same goal. And it is right that it's you need to distinguish between green bonds on the one hand and sustainability-linked bonds on the other hand. But just one sentence on green bonds. So I rather prefer companies that transform and put themselves on a path towards a more sustainable economy than rather unsustainable companies that have one green project and finance this project with a green bond. So I personally would say I prefer more and more companies issuing sustainability-linked bonds and hence setting themselves on a path of transformation.
Thank you, Bernard. I don't think we'll resolve the green versus SLB debate in the market today, but perhaps, Bram, did you want to make any comments before we go to the next theme?
Yeah, just one comment which I want to make, because I also I'm getting a little bit the impression that a lot of people think, hey, I don't have enough green capex, so I cannot issue a green bond. I think what must be very clear is that also with OPEX, you can also issue a green bond. That is also included in the EU taxonomy. And I think in particular, there are a lot of industrial companies who maybe don't have enough capex, but we've seen quite a lot of green bonds also being issued, combining capex and OPEX. And I think that works very well. But of course, on OPEX, you don't want everything to be spent in the first year and then have a maturity of 10 years, for example. So there should be some proportionate spending of those proceeds. But I just want to make it very clear that that is possible, and that's also quite common. We've seen that quite often in the green bond market already.
Yeah, I think it's a very helpful technical point, Bram. And we have indeed led a number of more OPEX-related green bond transactions that feature from be that retail, consumer, certain industrial groups, like you've said. And I think a number of the speakers have emphasized the importance of setting a credible target. So why don't we dive into the next section? Let me hand over to Nikesh.
Many thanks, Arthur. Good afternoon, all. I am Nikesh McPerry. And for the next section, we will focus on the analysis of SLB metrics and targets. So Barbara, turning to you, with SLBs that have launched in the market so far, we've usually seen 1 to 2 KPIs in the sustainability-linked bonds. In your view, what is the appropriate number of KPIs to be considered in SLBs?
Thank you. I don't think there's a hard rule. We would like to see issuers focusing on what's relevant, on what's material. Clearly, I would not go beyond like the 3 KPIs, for example. Already seeing 3 KPIs in the framework starts already being quite a lot. But then again, it depends on whether they are, for example, staggered over time, depends on the maturity of the bond. It needs to be appropriate. We've also seen, however, some companies focusing on only 1 KPIs and going straight for emissions reductions. And whilst this is, in general, always important as an overarching objective, maybe that's not the only priority for this company. Maybe because of their business model, the immediate attention should rather go, for example, on waste management or on water stress, on other material issues. So we would really like to see companies doing like a deep dive analysis of their underlying business and coming up with KPIs that are relevant and well thought through. Clearly, we've also seen predominantly environmental KPI. We start seeing a little bit more of the social KPIs in some situations. I know this has also been a little bit challenging more on the European side in terms of potential eligibility criteria for various purchase programs. But clearly we do appreciate when those social KPIs are there, again, if they are relevant. I think an important consideration in the structuring process is that we do expect companies to have a pretty large number of sustainability indicators and targets as part of their sustainability strategies in general. We do expect them to track progress over time. The sustainability linked bond is something that goes beyond the regular sustainability strategy of the company and really picks the most material of those indicators and again links the cost of financing to those. So it shouldn't be confused with, well, I'll just pick a couple of my general indicators from my overall plan and that's it. It really needs to be well thought and relevant, and it also needs to be an indicator where the company feels there's potential to accelerate in terms of pivoting that business model.
Thank you, Barbara. That's very helpful. So it's not about the number of KPIs, but it's more about it being relevant and it being credible. So Bram, do you think that SLB should just focus on environmental targets, as we have mostly seen so far? Or should we also consider social and governance targets?
Yeah, I think that's a question, and to be honest, I don't have the answer. I do think that overall SLBs they better cater for social and governance factors because they are sometimes a little bit more difficult to capture in the use of proceeds concept. So from that point of view, I think there is some right of existence for SLBs. But it remains very difficult, and I think one of the things, just to give one example, we've seen quite a lot of energy companies coming with SLBs to the market. I think we all agree that in the end, when energy companies want to do something significant, they should focus on scope 3 to really make a significant impact. So far, the SLB structures we have seen only include scope 1 and 2. And to me, that is not very credible. Probably they will include some kind of carbon capture storage techniques and offsetting. But I think what it tells me is that they are not willing to change. So I think overall, yes, you can also use it for environmental targets, but then really include also scope 3, because that is in the end where we have most of the impact.
Thank you. So Bernard, we already touched a little bit on this when we were discussing the previous section. But how would you determine if an SPT, so the Sustainability Performance Target, is sufficiently ambitious?
When we consider or when we determine whether a sustainability-linked bond is attractive in the first hand, then we of course have a lot of factors to consider, and most of them are linked more or less directly to the level of ambition of the sustainability target. So including pricing, the coupon step up, the number of KPIs and the time to the trigger event, all of these features of the bond are more or less directly linked also to the target itself. Because, for example, if you have a less ambitious target, then it needs to be in the not too distant future. Whereas if you have more targets or more ambitious targets, then you might put them further out on the curve. That might be a natural trade-off for the issuer during the structuring process. But still, all of these factors are relevant. And to touch a bit on the points Barbara and Bram also made just now, it's of course you need to have the right KPIs in the structure when it comes to the trigger event. At the moment, it's most often environmental targets and carbon reduction targets in particular. And I would also agree with Bram that we should see more carbon reduction targets that include scope 3 targets, because that's the most relevant of all. Also, we have still some sort of data issues and at that point, but we need to get that solved to really have the impact we all need. But touching a bit further on the determination of the target itself, whether this is ambitious or not. What we are doing usually is some sort of peer group analysis, sector analysis. Of course, also we look at the second opinions and what the framework itself says about the bond. But if we have, for example, a carbon reduction target of the company stated in the bond framework, then we would do some sort of sector analysis, including carbon budgeting and carbon accounting, where we can link the carbon reduction goal of the issuer to some sort of temperature alignment of the global warming. And then we can do the same link again to our investment strategies that, for example, try to align with Paris goals, trying to achieve or contribute to global warming limited to 1.5 degrees. And if the bond and the target that is stated of the bond in the bond framework is also aligned with 1.5 goal, for example, 1.5 degree goals, then it would, of course, be some sort of good level of ambition. But for that, of course, we need transparency. We need good data. We need the total scope 1 to 3 emissions included in the calculation of the KPI. But it's really a rather broad analysis we have to do when we try to determine whether a target is sufficiently ambitious or not.
Yeah, thank you. That makes sense. Transparency remains very vital and key. So Barbara, no two sustainability-linked bonds are alike. So how would you compare different frameworks?
Yeah, absolutely. That's what I mentioned at the beginning. So on our side, we have a sustainable bond evaluation framework that we normally apply to the assessment of every labeled green, social, sustainability, or sustainability-linked bond. So there's some sort of systematic analysis process that we do, taking into account multiple factors from the issuer's profile all the way to, again, the KPIs or use of proceeds, all the way into the granularity of the structuring details, such as coupons, such as the trigger dates. I mean, I can just think of examples of what we've scored highly or poorly, and just recapping a little bit also what Bran and Bernard have said. I mean, one key consideration is what proportion of the overall company's operations, for example, an emissions reduction target includes. We've seen very ambitious companies coming to the market with SLBs that did include scope 3, and the KPI actually covered over 90% of their overall business. So we valued that very positively. On the other side, we saw some companies coming with KPIs that included scope 1 and 2, and that covered 25% of their total emissions. That's not credible, full stop, as my colleagues were mentioning. On the social side, we've seen someone coming up with a KPI of women on the board. Again, is that really ambitious? In most cases, in most jurisdictions, that's a regulatory requirement. So it's almost given for granted that you need to achieve like a certain quota. So that's not particularly additional to showcase the efforts that you're undertaking on the diversity side. On the other hand, if you're doing something more, for example, on racial equity, on transferability of skills, you're financing certain programs that try and expand your employment to certain youth categories, to certain minorities. That's relevant, for example. And also, once again, on the environmental side, we like innovative thinking. There's been utilities, for instance, that have added a biodiversity component to their KPIs, and that was really, really interesting. Again, the waste management side for utilities that were highly diversified or more water attention. Emissions are absolutely crucial. Don't get me wrong. By no means I'm trying to underplay the importance of emissions reduction KPI, but it's not the only indicator. Let's be a little bit more creative when we structure this. We have 17 SDGs. I'm sure we can come up with additional KPIs that are particularly relevant to a certain sector and to a certain company. And again, we're also very open to have chats with issuers directly on this type of structuring process and provide very dynamic feedback.
Thank you, Barbara. That's a very comprehensive answer. It's good to know that you're willing to engage with issuers on the structuring of it. Before I hand the floor back to Arthur, are there any further comments or remarks from anyone on the panel?
Well, I would maybe just a quick reply to Barbara, because I really have to agree with her. It's so important that we have much more. We have more targets that we can use within sustainability-linked bonds, and it's really important to go beyond carbon reduction targets. Also, that's the most relevant at the moment, definitely. Maybe one sentence to the social targets within sustainability-linked bonds. Most of them, in my point of view, are rather linked to governance factors. When it comes to board diversity, that's some aspect of good governance. And the same holds true probably for racial factors or other factors. So most of these social targets are probably more linked to governance targets, and I would expect all companies to have good governance in any case. So that's more or less should be a given.
Perfect. Thank you very much, Bernard, and thank you, Nikesia. I think that takes us quite nicely to the third section, and a couple of the speakers have already mentioned this, the importance of not just a target, but then also what does that do to the actual debt instrument in terms of economic incentive that the issuer has set to meet the target. Bram, let's begin with you here. As you know, there's been sustainability-linked commercial paper programs, but there's also been 20, 30-year sustainability-linked bonds. How do you feel an issuer should best align the sustainability target vis-a-vis the tenor of the actual instrument?
For me, that is also a question which is really difficult to answer. And Arthur, I want to make a bet with you that all sustainability-linked bond issues we've seen so far, they're all going to meet their targets. And I think that is also a little bit showing the downside of the market right now. Because maybe as an investor, you actually should be hoping for issuers all not to meet their targets, because it shows they're ambitious and you're getting an additional return. But to add on that, I think in the end, if you take the maturity of a sustainability-linked bonds, it should probably not to be too far at the beginning. It should not be too far at the end. So you probably wanted somewhere to be in the middle, and you really wanted to have a significant financial impact. So 25 basis points 1 year before it matures, I think a lot of investors will think that will not be very credible. So probably somewhere at the beginning. And I also would say that the sustainability-linked bonds should not be too short-dated. I think also here the green and social bond concept, the use of proceed concept, works much better if you're only looking for a 5 to 7 year bond, for example. But I think sustainability-linked bonds, they can work better. First of all, with social and governance triggers, KPIs like Bernard just mentioned, and also a little bit more focusing on long term. But I think really important to have it probably somewhere in the middle. And yes, it should be more than 25 basis points. I think that is something which makes it, in my view, very credible. Again, the question about what is a significant KPI, that is still open. And I think that's, I'm repeating myself maybe a little bit, but I think we need more clarity and more agreement in the market what those KPIs are and how they should look like. So I think that is the part where most of the work should be done on developing this market.
Thank you, Bram. Not a betting man myself, but it's certainly a strong statement to say that there is no option value out there at the moment in the SLB market. But perhaps, Barbara, reflecting also on Bram's comments in the coupon step up and making sure that's deemed financially significant is important. And you've referred to the MSIM investment framework before when it comes to these instruments. Can you talk us through how this financial incentive, right, the coupon step up, impacts your willingness to invest?
Yeah, Thank you very much. No, and I would agree with all of Bram's comments in terms of where the trigger date should sit a little bit halfway, potentially between issuance and maturity, and just make sure that there's sort of enough, let's say, step up potentially payment period in between. And that's not, I mean, at the end of the day, as Bram was mentioning, we all hope the issuer actually meets their target. It's in our interest that they actually abide by their sustainability commitment. So hopefully that step up does not materialize, but we also need to look at it from a signaling perspective and the level of commitment that they project. So I would not say that it's a go, no-go decision on participating in an SLB transaction based on the step up. That wouldn't be accurate. But once again, it is an element that we do take into consideration as part of the evaluation. Again, if there's a much shorter period between the trigger date and the actual maturity of the instrument, we would expect to see potentially a higher step up. So, for example, we have seen a couple of utilities raising it to 50 basis points because there was almost less than a year between the trigger date and then maturity. We have seen some players going all the way to 75 basis points because the target was very far in time in 2030. But again, even though the step up is potentially very high, it's not ideal for us. We would like to see some interim targets that really also help us in the tracking process. The thing is that if the issuer doesn't provide those interim targets for their own business, well, we need to make our own assessment, and we will judge whether we believe they are on track or not. But that might not necessarily reflect some of the obstacles that the business is facing. For example, in increasing renewable energy capacity in some emerging markets in which they are operating. So the more the issuer is proactive in giving that information, the more elements we have to perform that type of analysis. I think one particular thing that I would flag, which is a challenge also from our perspective, is in the context of high yield issuers, because in that case we tend to see some call dates associated with the sustainability linked bond transactions, and in many cases we see the trigger date right before the call date. Now, when speaking with some of those issuers, they confirm that potentially some sort of penalty is also included in the call price, but that's not always the case. So, I mean, we want to avoid clearly a situation from a structuring standpoint in which there is an implicit incentive for the issuer to call the bond because they're not on track to meeting the sustainability objective. At the same time, that should not compromise the level of ambition of the KPI and the target itself. So it's a very fine balance and probably a difficult one to strike. But that's also why we need to rely on the advisors, the structurer support in order to convey that kind of messages to the issuers in the structuring process.
Thank you, Barbara. Yeah, in the drafting of SLB prospectuses, the interplay with co-option flexibility and mechanics is certainly a fun legal question to draft. Now, Barbara has given some examples of where the coupon step up has differed, but the vast majority of the market is still that sort of 25 basis point structure, whether that's IG or even many of the high yield precedents. How do you consider that? Would you like there to be more differentiation, or do you think it's helpful from a sort of simplicity point of view to sort of start with 25 basis points?
Thanks, also. No, I would definitely agree with Barbara and also with Bram. So what we expect to see is more differentiation in the coupon step-ups, and also at the moment, the 25 basis points might be appropriate because the level of ambition of the sustainability linked targets are not that ambitious. So it's most issuers will reach these targets, and hence we to for correct pricing of the bond, we need to put some sort of probability that the issuer will achieve the target. And at the moment, as most of them will achieve their targets, the step up is more or less irrelevant. And I guess that's also some sort of part of the equation that most investors at the moment don't feel that comfortable with calculating that sort of probability of the issuer reaching that target. But I would say that we certainly see more differentiation in the future as investors, but also issuers get more familiar with the framework. Also, I would say in the investment grade space, where step-ups aren't that familiar at all, we might still see some sort of common numbers. Maybe it's not 25 basis points, but rather 50 basis points or 75 to get this financial level of ambitious also on the cost of debt. But we most likely will see much more differentiation in the high yield space, I would say. But still, now we need to put that sort of probability of how likely is it that the company will reach its target. And hence, if the target is very ambitious, the step up in the future might be lower. And when it's less ambitious, the step up should be higher. But at the moment, the 25 basis points aren't still they are irrelevant for pricing, and hence it's not that relevant at the moment. But in the future, we expect more differentiation in the step ups, and in general, I would say more ambitious step ups as well. So higher step ups.
That's very helpful, Bernard. And I guess building on that, we've kept referring to step up here. Clearly, a number of issuers would love us to shift the conversation to step down. And we know some impact investors are open to that, and i.e. not wanting to be seen to benefit from companies not reaching their sustainability targets. Do you think, Bram, the market is ready for a step down structure?
Probably not yet. But I think it might be something we are going to see more in the future. I think we've seen a couple of bonds already, including some form of coupon step down in the market. Not a lot, but some. To me, it also makes sense because I think I like it a little bit more, philosophically to reward companies when they do good and they achieve some kind of ambitious targets. Of course, those targets, again, must be very ambitious. I've also heard the argument, hey, how can I explain this to my investors if I'm getting a lower yield on a bond if I reach a certain target? But I think it makes a lot of sense because if you as a company, for example, an oil company, have a very ambitious target to reduce scope 3, for example, the risk of being stuck with stranded assets goes down quite significant probably. And that also means that the credit risk is much lower. So you can really justify from that point of view a step down structure for an SLB. But again, I think we are probably a little bit early for this discussion. But I do think at some stage this discussion will become more part of the SLB structures, and I hope someday to also be more issued in this format.
Thank you, Bram. Perhaps opening it up, Bernard, Barbara, any thoughts your end around that, the idea of a step down?
May I jump in? Because I would say in the end, it shouldn't make a difference if it's a step up or a step down for the yield of the bond. Of course, it makes a difference for the coupon. But if we get the probability of reaching the target right, then it shouldn't make a difference in the end. Because I would say that rather ambitious targets might be hard to reach, and then a coupon step down, if it's reached, might be credible or might be appropriate. Because in the end, I would expect targets that are less ambitious are then you have always the same yield curve. In the end, if you understand what I mean, right? So it's more ambitious target, and then you you might get a coupon step down, but less ambitious target, you need to have a larger penalty in the end to compensate for the target. So it should be the same, both sides of the equation. But I would agree with Bram that at the moment, most investors aren't ready to accept a coupon step down at the moment, but that might change in the future.
Yeah, I mean, I would agree with that. I think at the current level, as we mentioned at the beginning, this is still a very nascent product, so it still needs quite a bit of testing in its current form with the step up only. I think from our perspective, it's still pretty difficult to justify a step down, and it would open like an even more complex discussion and create even more potential incentives for setting targets that are not necessarily super ambitious, and so the assessment process would complicate itself even more at this stage. However, I do agree with Bram that there needs some sort of benefit also from the issuer's perspective, but I think this will come pretty naturally. Well, first of all, we're starting to see some initial evidence of some sort of greenium also on the SLB format, especially for the ones that, at least from our perspective, we consider very strong and a very good fit with the overall transition of the company, which is the ultimate underlying rationale of SLB. But I also think, as I mentioned at the beginning, that with the advent of more granular taxonomies and disclosure associated with that, we do expect to see some sort of natural kind of tiering in the cost of capital. I mean, at some point, companies will be obliged to basically report what percentage of their business activities and underlying financial indicators are associated with strictly green activities. And I would assume that will have some sort of impact on their cost of capital, with an advantage clearly on the greener side and the potential steepening for the browner ones. So I think that type of benefit might come, but not necessarily in the form of a step down, but more embedded into the overall definition of green and sustainable as part of our ongoing business.
Excellent. Thank you both. And that concludes the third section